Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, September 2nd, 2016. The week ahead promises to be relatively quiet, and so far the stocks have liked Janet Yellen's comments on Friday, or rather last week. So the small caps, technology, semiconductors, and financials hit all-time highs, while the utilities have closed the gap from recent gap up. Bonds could easily break to all-time highs. We'll look at TLT and AGG. Then we'll look at the Forex universe. Gold pops off support, while GDX followed it as well higher. Oil had a pretty terrible week and lost almost 7%. And I'll show a couple of oil trades that we did with my MasterChartsTrading.com service. We'll also look at natural gas that is moving sideways, but I think the bigger trend is up. And then we'll finish off with agricultural commodities, corn, soybeans, and wheat. So first of all, I want to show that next week we'll have several events that could affect the markets. On Tuesday, there is ISM non-manufacturing report. It's important, but it's not like life and death kind of important. Wednesday we have Japan's GDP. Also, this could be a market moving event. And then on Thursday, I think this one is the biggest one of the week. September 8th, so Thursday, we have ECB rate decision. So European Central Bank will announce its interest rate decision. I'm not sure if it will strongly affect, because I think it's pretty much priced into the markets right now. All right, let's start off with S&P 500 ETF SPY. We are very close to all-time highs. These are all-time highs here just a couple of weeks ago. Now Friday, it's a relatively good-looking day for stocks because there was a gap up in the morning, and the gap actually still remained more or less, throughout the day. So it was not completely closed. So there is a little bit of a gap. Well, this is a partial gap, I suppose. So this looks, to me, this looks like a clearly bullish chart for multiple reasons. Here's reason number one: we are at all-time highs. Reason number two: 50-day moving average is above the 200-day moving average. Reason number three I'll show in the next chart, but on this chart I wanted to show the intermediate term Bread's momentum oscillator, and one of my favorite indicators is this one here. This is a kind of like a MACD, MACD of the advanced decline line. First of all, advanced decline line is at all-time highs, which is a very good thing, a really important measure of the participation of the market. But the only thing that I am a little concerned about is that we have been in the positive territory since February. So a foray into negative territory could be like a reset for the weak hands that are still buying at this all-time highs here. Here is S&P 500 actual underlying index. This will be the longer term time frame, also daily time frame. So reason number 3 and 4 I wanted to show here are the 200-day percentage of stocks above the 200-day exponential moving average and the bullish percent index for the S&P 500, and they're both in the 70s. So it is extremely, well, not extremely, but this is very bullish. Even if you set your trigger very high, so let's say you set your trigger at 70, that means that in order to consider the S&P 500 to be bullish, you have to hit 70% of stocks to be above the 200-day moving average. And the same for bullish percent index. We are there, so we hit 70%. And let's say you say that you consider the to be S&P 500 to be bearish if we hit below 30. So we're still way down, way to go before we even remotely get to the bearish territory. And 50% is kind of like a no man's land. So I look at it around 60-40, but you can even set it to 70-30. So we hit plus 60, and we just remained above 60 here since when is this, March, and since March here as well. So generally speaking, S&P 500 is bullish. My proprietary market breadth index consists of many inputs. By the way, these two are not part of the market breadth index, and it became bullish. This market breadth index became bullish in June, and basically from this point on, I consider it to be in a bull market. Before this, I was looking at it only from a bearish perspective. And here is S&P 500 from a very long-term perspective. This is a weekly time frame. First of all, this is extremely unusual behavior because we hit 2-year low just in February, and then we turned around and hit an all-time high. So this is me being bearish here, just recently and up until what did I say? As early as June. It's not, not out of the question. But again, I am not perma bear or a perma bull. I am only looking at objective evidence. Well, I try to look at objective evidence, but at the very least, I am not saying that only bearish or only bullish. I am looking at it from a point of view of what's at hand right now, and at hand right now is a bullish security. And the bullish security, another reason why we're I would consider this a bullish security is because of this breakout, and this is a clear breakout on weekly time frame, and we went to all-time highs. So a test of this breakout would not be unheard of. But so far, we pretty much any time we come down even close to this breakout, like for example right here, the week of August 1st, it was immediately bought. So far, pretty much any dips were bought by the people who are trying to jump on board of this potentially quite bullish chart. Another reason why I think that the general market is bullish is because of the small caps performance, and S&P 600 small caps index is at all-time highs. In fact, this week was a very good looking bullish candle with the candle ending the week at its highs, so that's very bullish. Close and highs are very at the same time, at the same place almost. So yeah, small caps are a higher beta, higher risk proposition from compared to the general market. So leadership from the small caps, and looks like we are breaking out to all-time highs on bullish candle. This is a welcome sign for the general market. You can play this ETF via you can play this index via the ETF called IJR. You can also do IWM, but for some reason IWM seems to consistently underperform IJR. Another positive sign for the general market is a leadership from the technology sector, and this is XLK, all-time highs this week as well. So this is a positive sign, and XLK itself is geared more tilted towards the larger cap. But if we look at the equal weight technology, RYT, and this one it considers every single stock within technology sector is equally weighted, then you can see that also equal weighted is at all-time highs. So this is showing broad participation within the technology sector. So it's just not just a couple of stocks pushing the sector higher. Within the technology sector, as a group that stands out is Semiconductors, and this is a very strong looking group. Looks like we had a breakout right there to all-time highs, and we just continued higher. Now these are all-time highs, pretty strong move of the Brexit lows. This is what, 28%, so a pretty impressive move. This is a very or rather relatively high beta stocks are within the semiconductor industry group. So this shows a good appetite for risk, and good appetite for risk translates into a general stock market bullishness. Another one that I was kind of surprised about is financial sector, and we know that financials come under pressure when the bonds are also moving higher, but in this case the financials seem to be shrugging off that proposition and are also at all-time highs. Now these are equal weight financials. The regular XLF, it's still a little bit behind, but RYF, the equal weight financials, are actually these are at all-time highs even. These are all-time highs. So this shows, two sectors, the financials and the technology. If they're leading the general market, this is showing very strong appetite for risk, and this is a good sign for the general market. Most likely we will see fresh highs in S&P 500 rather soon. And, we are very close to all-time highs, so fresh all-time highs would not be very surprising. Can we unravel and completely collapse from here? It's possible. That the likelihood of that event is low, honestly. And finally, from the equity perspective, I want to highlight XLU. So XLU utilities, they're somewhat more interest rate sensitive than the rest of the market, but these are also all-time highs, and this is a bullish chart. So a pullback from all-time highs is absolutely normal. In fact, here we closed the gap, and here's the gap that I was talking about. This is a gap above resistance. Let me show it here. So this was the previous resistance right there, and then it gapped up to new resistance and ran to all-time highs. And these are actually continuously all-time highs. Now we came down, we closed this gap. So generally speaking, I think this is a bullish chart again, and especially if the bonds, which I'll cover next, continue moving higher, or at the very least not drop, I think utilities are also going to be moving higher. And of course, utilities are normally bought for their stability and for their dividend payouts. And here is weekly XLU. Here I wanted to show that we are basically at the resistance. A resistance that turns support. Well, this is the first support. So if we do hold here, this is, obviously, if we hold here, then we could just bounce to all-time highs again. If we don't hold here, then there is more support above, around here, around 47.25 or so. And then there is a lot of things happening in that area as well. So another area of support would be around there. All right, this is TLT, the bonds, 20+ year treasury bond fund. Just like I showed the XLU, you can see the similarities between the charts, but this is a lot more steep, of course. So this was almost vertical. Well, this is a vertical advance. And I mentioned, if you listen to some of my videos, that I would never buy up here. Now we need to see a correction. So looks like we're getting that correction, but that correction is relatively tame, and it mostly is moving kind of like a sideways consolidation, and this could be a pennant or a triangle consolidation. So if we see a breakout, let's say a close above 141 here, then maybe we'll see new highs. Maybe we'll see all-time highs. I see this chart to me is bullish, so I'm not even considering looking for top-end patterns just yet. And I just don't see a top-end pattern here just yet. Here's the weekly time frame for the same chart, TLT. You can see the sideways consolidation, basically just moving, well, sideways. So first we broke out to all-time highs, and then we just kind of pulled back and moving sideways. Here's the more diversified fund. This is AGG, and this one is even even stronger, I think. See, you can see that here we have touched the 50-day moving average, but here in TLT we closed below it twice. So you can see that TLT is somewhat weaker. You can also think of TLT as somewhat more volatile. And in fact, TLT is even more volatile than S&P 500 based on the volatility figures. So anyways, HGG, you can see clear support here at 111, what is it, 111.78 or so. So if we break that, then we may want to reconsider. Well, I mean, there's a tons of support. There's this gap, so there's support here. Then there is this gap, so there's support, I'm guessing, down here. And then, so there's a lot of support still here, and this is all-time high. So again, I would not be surprised if we simply just break out to all-time highs and continue higher. Here's that same AGG chart on a weekly time frame, and this could be like a bull pennant or a bull flag. And then if we, like I said, if we break out above this pennant line, we could easily break out to all-time highs. Anyway, so I would not write off bonds just yet. If anything, they bring in nice dividends and bring stability to the portfolio as well. Right, moving on to the Forex universe. This is US dollar index on a daily time frame. So for now, this week, there was, I think the resistance here is reaffirmed for now in the 96 area, 96.50 or so. And looks like the dollar was not able to break out above this level. And of course, there is more resistance up here at $97 or so. So, and then there's more. Anyways, but this is on a daily time frame. So this is a, you can see it's a very choppy chart. And in general, I think Forex is quite a bit different than the stock and bond universe. But in any case, here we see for now the resistance has been reaffirmed, and we did not break out above this level at 96.50, and then we kind of came down. Now, long term, I think we have a bullish chart. This is a long term of the dollar going back 3 years. So we had a base consolidation breakout, and then basically we're moving sideways for the almost 2 years now, more or less in this range of 93 to 100 points. This could be a double bottom, and if it is indeed a double bottom, then we can break out above 100 and continue higher. Alternative scenario, of course, is a breakdown below 91 here, in which case this whole breakout may need to be re-evaluated. Versus the euro versus the dollar, nothing has really changed. This is a weekly time frame. I still think this is a bearish chart, so we had a big plunge, and now we're kind of bouncing back and forth. And remember, this is a weekly chart, so this is 3 years worth of data. We could see euro, and I keep saying we could see euro come up into this area here and then retest this break, retest this area. If euro manages to break out, then we will most likely see a dollar break below the support. As far as the British pound versus the dollar, I mentioned that we had the outside reversal here. This is the red candle right there, and then the white candle engulfed it. Next week we had the confirmation, and then this week we had further follow through. I think, British pound could bounce to maybe around here to $1.30, $1.38, $1.36, $1.38 area. Because it's really overextended. So a bounce here, it looks like a bounce is materializing. I don't know exactly where it will go, but this is a bearish chart to me. So a bounce here, if you're trading Forex, most likely will be shorted in this area. And here is US dollar versus Japanese yen, a chart that I keep showing. So again, I don't know exactly what's happening here, but it looks like the support in this area is reaffirmed again. We get 1, 2, 3, 4, 5, 6 times we touch this area into 100.74 area, and now the second week we're bouncing. So could be that this area is of really strong importance to US dollar versus the Japanese yen, and the dollar could be strengthening versus the yen. So if the dollar strengthens, of course, then the general dollar index may also appreciate as well. Of course, the dollar weakening versus the dollar index weakening is helping gold because gold is traded in dollars. So this week, this is a daily time frame for gold. Looks like we're attempting to hold support here, and next chart it will be even more clear. But the reason why this is an important level is because of this. There's a breakout to new highs. So first test, and this is a second test. So looks like we're coming down and we're testing this breakout. If we hold here, then we could appreciate and see 52 highs again soon. An alternative scenario is we don't hold here, and we could actually drop back to maybe 1252 and even possibly lower to this level, 1200 or so. Here's a weekly time frame, and for now this weekly is looking good. This looks like a bullish chart, and here's that breakout I just showed at 1300 at 52-week highs, first a test, and now we're second test right there. So this week this could be a hammer candlestick. So if this is a hammer candlestick and we see follow through, we could continue higher and maybe even break out two fresh 52-week highs. This also will strongly depend on the dollar. If the dollar comes under pressure, then gold will have more room to appreciate in dollar terms. Here's the weekly time frame of gold going back 5 years. I showed this chart in the past. It's just for illustrative purposes, showing that basically we had multiple attempts at breakout and attempts to go higher, but this was a bear market in gold that ended just recently, like around March. This is my proprietary gold breadth index, and it has signaled a beginning of a new bull market in gold. Now, where this bull market will continue is pretty much anybody's guess, but we could go to 2,000, 20,000. It doesn't really, I have no idea where it will go. For now, I'm treating this as a bullish security, and I'm looking for bullish opportunities. I'm not looking to short gold at this point. This is gold versus the US dollar, and the inverse relationship is quite obvious. But sometimes, occasionally, we have forays of gold and the dollar being positively correlated. And in fact, right now, it's one of those time periods. Right now, we have gold and dollar being somewhat positively correlated. In other words, both gold and dollar are moving up. Go figure. Finally, here is GDX, Gold Miners ETF. Now, this one is significantly more volatile than gold itself. From the all-time lows, actually, I need to extend this chart a little bit so that I show what I'm talking about. These are all-time lows back here in beginning of this year, and now we are 52-week highs, so this is almost tripled from $12.40 to $32 or so. We came down pretty sharp, gapped below this 50-day moving average, so there was a lot of selling here. But now with gold potentially holding support, gold miners also popped. As far as the breadth of the gold miners, we have data for gold miners market breadth, and gold miners bullish percent index is one of my more favorite indicators. So again, it was at 100 here in July. I pointed this out. I said I would never buy when the bullish percent index is this overextended. In other words, there is nowhere to go. It's at 100. So it, it continued a little. It actually popped a little bit higher, but then it came pretty hard. Came down pretty hard. Now we have a bullish percent indexes at around 53%, so it's a little bit more reasonable. And we'll see where that goes. All right, this is oil on a weekly time frame. West Texas Intermediate. Really bad week for gold, for oil this week. First we had a gap down. It attempted to close it. It actually didn't even close it all the way, and it just kept pushing lower. Only at the very end of the week we had some buyers step in. So for the week it lost a little bit over almost 7%. Now, again, maybe this is the resistance coming into play here. It's a little bit actually lower than I expected the resistance to come in, but it did come in here. So we'll see where it goes. Generally speaking, I'm viewing oil as a bearish security. I'm not trying to pick any bottoms, so I'm trying to short it. And I wanted to show you some of the trades we just did with the MasterCharts Trading. So if you do sign up, you will get access to this kind of charts, and this is exactly what I'm talking about. You will get exactly how I do it. So I say entry, I get initial stops, you get 3 targets, and I base my entries on ATR, on average true range. If you have any questions, you can send me an email, by the way. So these are previous 2 trades, and they were both successful. Actually, I think they're extremely successful. So both of the trades have reached 3 targets. And so, for example, for previous trade, the entry was, let me see, it was somewhere in June, end of June, and then all 3 targets were reached. We exited, we exited and let the security come down. Now we just recently re-entered right here in August. Almost immediately we had all 3 targets just within a week or so. All 3 targets were met. So I took profits, and I'm just sitting on the remainder of the position and see. Sometimes it goes higher, sometimes it just stops and just continues higher. So why sell it if my stop has not been hit? So that's what I meant to say is if you sign up for MasterChartsTrading.com, you'll get similar charts like this. Moving on to natural gas. This is a daily time frame for natural gas. This is a bullish chart, I think. We had a breakout here about the major resistance and basically a 52-week highs and attempting to go to 52-week highs again. Here is a weekly time frame for natural gas, and this is the weekly. This is the place I kept telling about, $2.50. So we broke out above it, came down, basically tested the support, held support, and now we rallied. So we're attempting to break to fresh 52-week highs. So far, I did not. We didn't break to all-time to 52-week highs, but I think this is a reasonably constructive chart, and I think we may actually break to 52-week highs soon. All right, and finally I wanted to show some of the agricultural commodities we also follow at MasterChartsTrading.com. This is corn on the weekly time frame. You can trade this with an ETF called Corn, C-O-R-N. If you like to trade commodities. These things are very volatile, so you have to be extra super careful. Now, what I thought we had a breakout here, and it clearly didn't hold and got completely demolished and sold off. We had support here that didn't hold either. Now we again pretty much at support here at another support back from 2014 for corn. So this looks like a hammer candlestick at support. So it's possible maybe support has held, but this is a very wild looking chart, honestly. Soybeans, this one is more constructive, I think. This one is more bullish, and you can play the same ETF, SOYB. these are 52-week highs, so this one is a little more constructive than the previous one. And we're kind of coming down to this area, but it's hard to draw support line on this particular chart. I mean, there's support here at 904, but there's very strong support even lower. We'll see if it holds here at 943 because there's two touches here right now. So possible it has held already. Finally, wheat, and here's what I wanted to show. Multi-year lows does not necessarily mean it's a great bargain. In fact, if you listen to my videos, in beginning of July, I actually said, oh, this looks like a hammer candlestick right there. This is a hammer candlestick. And a weekly hammer candlestick for that matter. So notice that absolutely nothing has come out of that. In fact, we broke two new 52-week lows, or rather multi-year lows, and continued lower. In fact, this week we hit yet another multi-year low. So attempting to pick bottoms in a bearish security, and this is a bearish security, is dangerous. All right, if you like what you're hearing, please consider signing up for MasterChartsTrading.com. Please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.